This is a reasonably big question. I can probably finish up to here. Okay, that means I'll finish up all the individual questions. Like I said, I'm collecting all the individual groups out first. Are you clear now? Let's look at this one. It's a statement of financial position for Robby Group. Let me just get this Robby Group set up for you. Let's add another one called Robby. Okay, we'll start at the bottom first, as usual. Alright? Let's look at the last adjustments. Work through the last adjustment. Okay. Immediately prior to year end, Robby sold a land to third party at a price of 16 million with the option to purchase the land back. Okay. On 1 July 2003 for 60 million plus a premium of 3%. The market value of the land is 25 million on 31st May 2003. And the carrying amount was 12 million. Robby account for sale, eliminating bank overdraft. Okay, fine. Looks like Robby did some window dressing. We call this a window dressing activity. Does it make sense? This is a window dressing activity. Now, this window dressing activity, they have recognized the profit. They shouldn't recognize the profit because there was no sale. I clear now. If you can buy back and compared to the market rate, you're buying back below the market rate, it means basically it's a financing arrangement. I tell you, it's not a sale. This is not a sale. This is just a financing arrangement. So you have to reverse the whole thing out. So if I ask you to reverse this, how to reverse this? They already did it. Reverse it. What's the reversal? Can you give me the reversal? Hurry up. What's the reversal for this one? What do you think is the reversal? Debit, credit, what? Debit, what? No, you don't have revenue here. You're doing a soft P account. So, if you're doing P&L, you say revenue. If you're doing soft P, you don't say revenue. You say RE, OCE. Are you clear now? So, what's the reversal? First of all, understand what they did. What did they do? Debit bank, how much? 16. Credit? PPE, how much? 12. Then, another 4 go where? Income statement, RE. Are you clear now? This is what they did. Now, right or wrong? Wrong. Reverse. How to reverse? Okay. Understand, huh? This is how you look at the question next time. Got it? So this one, reversal. This is note number what? Yeah. Okay, done. Finish. Make sense? Clear? Understand or understand this one? Clear? You can't reverse the money back, right?
Yeah, because it's first bank, right?
They took the money and covered their bank one. So actually it's their current liability. They owe somebody within the end of the year. Got it? Can I move on? Are we all okay? Okay, moving on to the next part. The next part, okay. Robby held a portfolio of trade receivable with carrying amount of 4 million on 31st May. At the date, entered into a factoring agreement with the bank whereby it transfers the receivable in exchange for 3.6 million cash. Robby agreed to reimburse factor for any shortfall of the amount collected in 3.6 million. Once receivable had been collected, any amount above 3.6, less interest of this amount will be repaid to Robby. Robby has derecognized receivable and charged 0.4 million as a loss to P&L. Now, should they derecognize the receivable? Yes, no. Answer is, this one is note, what note is this note? E, yeah? Derecognition only is done after risk and rewards are passed. Robby still retained. Does that make sense? So how to do reversal? Can you reverse for me now? Can reverse or not? Reverse. Hello, reverse anyway. Journal only. How to reverse? Credit receivable ke? They already credit already, right? Debit bank ke? Debit bank receivable. So how? Credit returning how much? 3.6 ah? 4. 0.4. Wow, tembak every number possible lah. 0.4 ah. Okay, right. Now, the other one is credit where? Credit where? CL, current liability. Okay, you all having a hard time doing reversal lah. Okay, are you clear? Anybody give you short-term money, it's current liability. Doesn't matter how they gave it to you. Can you remember this? Anybody give you short-term money, current liability. They give you short-term money you must pay them back. Temporary what? Financing. So financing got two type of financing. Long-term finance, short-term finance. Long-term finance, non-current liability. Short-term finance, current liability. Finish. Are you clear now? Factoring is short-term or long-term finance? Then where should it be? Current liability. Unless they have without recourse. Are you clear now? Clear? Without recourse, you sold the receivable to them. Does that make sense? You have to understand what type of factoring you got. There are two types of factoring. One, the factor say, I take everything, I won't bother you. That one, you get the money, you derecognize the receivable. The other one is the factor say, I take your receivable, but if anything go wrong, I bother you. That one, you current liability. That's all.
That one is recourse, right?
Clear? Not clear? With recourse, without recourse. Got it? See the type of financing. Read the transaction. Is it short-term financing, long-term financing? Short-term financing, like previous also, he sell the land and then buy back later. That one is short-term or long-term? Short-term financing, yes or no? Current liability lah. Don't think so much. If anything financing, only three places: current liability, non-current liability, equity. You decide where to park it. Clear?
Example of equity.
They issue share, they issue warrant, and then they said, oh, I issued warrants to the current shareholders, they paid me 1 million. Oh, they issued warrant to the current shareholder, equity but not share, so OCE. Debit bank 1 million, credit OCE 1 million. Are you clear now? Warrant, you know what is warrants, right? Share warrants and all that. Clear? Follow, don't follow. Understand, huh? Can I? Okay, right, let's move on to the next one. Okay, you try this one. Robby purchased a PPE for 10 million on 1 June. Its expected useful life of 20 years, depreciated straight line, PPE was revalued to 11 million. At 31st May 2003, impairment indicator triggered impairment review. The recoverable amount of PPE is 7.8. The only accounting entry posted the year was depreciation based on revalued amount. Robby accounting policy is to make excess depreciation arising from revaluation. So to make transfers for revaluation. So how now? This one I got to teach you how to solve this problem, right? There's a technique I got to teach you, remember? Note D. You start with item. How many dates there? I think got 3 dates, right? What's the 3 date? When they bought it, when did they buy it? 1 June. 1 June. X. Okay. Next one is 31st May. X2, is it? Then the next one is 31st May. X3, right? Yes, no? Okay, you remember this diagram? Calculate the original value first. Calculate the original value first. Done. So you started with how much? Original cost is how much? 10, right? How long is the life? 20. So here what will be the value actually? Carrying value should have been 8, 9, right? Here would have been 8.5. Okay, are you clear? Then they revalued here, right? 11, right? Yes or no? 11, then 18 years. So how much is the closing value there? 11 divided by 18. So 10.39. Then it go down to how much? 7.8. Okay. Are you clear on the flow here first? Yes, no?
So I don't get 10.39. Yeah.
The 10.39, you see here is how many years really?
2.
You check the life. Life 20. Here is life is 18. So 18. 11 divided by 18 is how much? 0.61. Yes or no? 11 minus 0.61? You have to do new depreciation. Are you clear now? Follow? No, you have to depreciate it based on the new value, 11. 11 divided by 18, the new depreciation is 0.61, no longer 0.5.
Oh yeah.
Revalued depreciation, right clear? Got it, huh? Okay.
7.8, 8.1 minus 0.6.
No, which one? 7.8 given. There.
Can you repeat the first part?
7.8 is given. Here. Okay, you mean
10.3.
10, 9, 8.5. You know how to get that one, right? 10 divided by 20 is 0.5 every year. So this one is 2 years, minus of 1 already. Okay, now. Then this one minus of 0.5. So everything just follows standard, as if what is the value, as if normal depreciation. Got it? This one, 11, is because it's revalued at this date, it becomes 11 already. So you put 11 inside here. Then got life of how much? 18 years life. Are you clear now? So you divide by 18 now. So you should get 0.61. Does that make sense? Clear? Not clear. So once you got that one, so you minus 11 minus 0.61, you should get the 10.29. This is the revised carrying amount under the new depreciation value. Then you go down 7.8. So now you just have to figure out how much is the, how much is the loss. Are you clear now? So here, the loss is going to be how much? Okay. So here, they only charge depreciation. Remember, they have only charge depreciation. Okay. Which means they haven't done the following. Transfer for excess. Debit RR, or we call it OCE, 0.11. Credit RE, 0.11. Okay, do you know how to get this 0.11? 0.11 is the difference between the depreciation here. Here to here is 0.5, right? Here to here is 0.61, right? Extra is 0.11. This one must transfer up. Pay attention, huh? Transfer for excess depreciation. This is a policy. Then this one, you go like this, huh? You go down 2.89, correct? From here to here is 2.89, here to here is 0.70, here to here is 1.89. Okay, make sure you know how to get these numbers, huh? Make sure you know how to get these numbers.
Revaluation to original or CE, original to impairment, RE.
Yes, very good. Are you okay? From revalued, from here to here, OCE. From here to here, go to RE. Are you clear now? That's why you need all those things, huh? Or no, you cannot get the numbers. This one is if there is transfer. If there is no transfer, it's from here to here and then
If there is no
transfer.
transfer of excess depreciation.
Yes. Wait, it'll actually not be going that way, sorry. If there is no transfer, hold on. I better make a note about this. Okay. If there is no transfer, I better make a note so that you catch it. Depend whether got transfer policy or not. If got transfer policy, is up. No transfer policy is like this. You know how to get the 2, no?
Transfer of what, sir?
Policy. It's a I-16. Yeah? Robby accounting policy is to make a transfer of excess depreciation arising on revaluation. This is a policy statement. If this policy got means, then first answer. If this policy don't have means or silent. If never say means second answer. Are you clear now?
So, good answer.
Huh?
Good answer.
Huh? 2.89. Which one? The drop. The drop is 2.89, right? 10.39 minus 7.8 is 2.59. Eh? 2.89, right? .5
0 per month we get.
Oh yeah, yes, 2.59 I think so, correct?
This is the 0 per month.
2.59 is it? So here will be how much? Is this correct? Ah, yeah, 2.59. Correct. 2.59. Yeah, sorry. 2.59, right? Yes, no?
How do you get OCE?
How do I get OCE? 2. 9, 11. Up to. From here to here, how much? Total down is how much? 2.59, is it? Down all the way is 2.59, huh?
Yeah.
Okay. Then correct.
So, how do you get 0.5 now?
Which one?
Or RD of transfer?
How do I get 0.5?
5.
This one.
Yeah.
Balancing, huh? Balancing.
The OCE.
The OC2 came from if this one there, remember? Going up to. Are you okay now? So it depends, this impairment, you have to think about it properly. Follow? Okay, I will stop there for today. Are we okay? Can? Any questions there?
I love the OCE 0.11.
Where do I get the 0.11? Is it? The 0.11 is the difference between here. Notice here to here is 0.61, and then here to here is 0.50. So the difference between these two. Are you clear?
So logically, the difference 0.59 that is included, is it?
Yes.
That?
That one has to go to P&L because you burn through your. You see, when you're going to burn your profit, you burn through your reserve first. What? Your revaluation reserve first. So if the company got no transfer policy, the revaluation reserve is holding 2. So you have to burn the 2, then only you can go hit your P&L.
Still need to burn now.
Must burn first. You cannot leave that one first. That one is you realize the reward, lost the reward. So realize everything. Does that make sense now? Clear? Not clear. Okay. I will stop there for today. I finished Robby last class some of the adjustments today, correct? Yes, no? Is there a Robby? Page 59, is it?
We did last Sunday.
Yeah, I did a bit last. I did the following adjustments. I did which one? I think I did F, E, F, and D. C I haven't do yet, right? Okay. Now let's look at C. Robby has a 40% joint operation, a natural gas station. Asset liability revenues and costs are apportioned on the basis of shareholding. Following information relates to the joint arrangement activity. Natural gas station cost 15 million to construct and was completed on 1 June and is to be dismantled at the end of life of 10 years. The present value of this dismantling cost to the joint arrangement is 1 June is using a discount rate of 5% is 2 million. 2 million is the total cost of the whole thing. You will take how many percent? 40%. Okay. In the year, gas with direct cost of 60 million was sold for 20 million. Additionally, joint arrangement incurred an operational cost of 0.5 million during the year. Robby has only contributed and accounted for its share of construction costs, paying 6 million. The revenue and costs are receivable and payable by the other joint operator who settles the amount outstanding with Robby after the year end. Okay. How to account for this set of transaction? Okay. Have a look at the books first. In the book, you will see something. Can you see this one? Page 59. 59. Can you see this one? Okay. This one basically says joint operation. You don't show it as a separate line. Joint venture only you show a separate line. Can you remember now? Joint operation is you straight away go into your own asset, whatever it is. It doesn't actually show a single entry. Joint venture only shows a single entry. Are you clear now? Got it? Okay. So this one you have to do some correction lah. In other words, in their accounts, they already created an account code called joint operation, which is wrong. Understand? So how to account for this? Okay, these are the accounting for Robby. Yeah? This is note C. Yeah? How many year life? 10-year life, right? Are you okay there?
That means that this joint operation activity does not take into account at all.
Nothing is taken into account. Can? Okay. Follow, don't follow. Any questions there? A lot of marks for this. You have to do massive adjustment for this. 1, 2, 3, 4, 5. It affects your receivable, your payable, your provision, long-term provision, PPE, joint operation, retained earnings. Are we clear? Did I miss anything? I don't think I missed anything else, right? That's it. Clear, not clear? Got it, that? How do I get the depreciation? Depreciation is, you see this one? 6 must plus with 0.8. 6 must plus 0.8. Got it? Clear, not clear?
Depreciation is
0.68. You know how to get 0.68? Clear?
Take within cost plus the dismantling 2 million, 40% of it over 10 years, same thing.
Should be the same. Let me try and see. 15 plus 2. Same. Are you clear? Follow, don't follow. Any questions there? You understand, huh? Okay. Next one.
This is unwind the provision.
Yep. Long-term provision must unwind what? This is dismantling cost. Remember, dismantling cost is long-term provision. Long-term provision must unwind all the time because you PV it initially. So they already PV for you. The 2 is already present value. 2 already discounted. That's why you unwind it later. Are you clear now? Follow? Okay. Now let's move on to the next part of the question. The next part of the question basically asks you to account for 2 things here. Yeah, it shouldn't be a problem. I think you should be able to set this up very fast. Group structure. We got hail and zinc. You read the question. Looks like Robby has both hail and zinc, so basically there's no sub lah. So you can go straight already. Check whether there's any changes. Yeah, nothing much. It's just a step up, small step up acquisition. Are you clear? So it shouldn't be a problem. Had until note F, right? Yes, no? Note D. This one, right? Note D. It's going to be net effect is what? Yes, no? Understand? Can. Clear? Note E. RE 0.4. Can we okay so far? Can I? Okay. Now that you know all of this, can you do the last one? Do hail.